All right, everyone. Hello again, and welcome back to session 2 of the 2021 Conservation Finance Virtual Bootcamp. I'm Helen Rogers with the Conservation Finance Network, and on behalf of my colleagues at CFN and our partners at Highstead and the Yale Center for Business and the Environment, thanks again for joining us. Also, we invite you to engage and share any ahas or takeaways you find significant on social media using the hashtag CFN Bootcamp, and we'll drop that in the chat just here shortly. And then lastly, we'd like to have as much interaction as possible this week and ask for your help in kicking that off by sharing your name and organization and location in the chat. For over a decade, David Hoffer with the Lyme Timber Company has partnered with the Conservation Finance Network to present principles of finance as part of the bootcamp convening. Do you ever wonder what goes through the mind of an investor or what to expect when you're blending capital on a complex conservation project? For this session, David will help define and explain financing terms and concepts, including basic transaction structures, how varying stakeholders come together in conservation transactions, the time value of money, and key considerations affecting financial returns. Before we get started, just a reminder that today's sessions are being recorded and will be distributed to registrants at a later date and published to our website. And to please also keep your audio on mute throughout the presentation. And if you have any questions, please type them into the chat box. We'll pose questions throughout the presentation as well at the end of the session. I'll hand it over to you, David.
Thank you, Helen. Thanks to all of you for being here. Glad to be with you this afternoon or morning or evening, depending on where you are. My name is David Hoffer. I am the president and one of the managing directors of the Lyme Timber Company in Hanover, New Hampshire. We are what's called a TIMO, a Timberland Investment Management Organization. And for the last 45 years, Lyme Timber has been in the business of making investments in timberland, in other real estate properties that in particular have some unique conservation values or attributes. And so we have partnered over the years with a number of conservation NGOs that will be familiar to many of you. But at the same time, we are an investment firm. We raise capital from investors who are interested in investing in timberland, in environmentally sensitive strategies for managing rural real estate. And we've tried to sort of stay on the leading edge of some of the investment strategies out there that enable both conservation outcomes and attractive financial returns to be generated as a result of our activities. So I have been tasked with an interesting challenge, which is to speak about both how conservation-oriented investment transactions are and can be structured, but also to talk about the incentives that in particular private investors have when they engage in these sorts of transactions, and then to drill down into some of the mechanics of financial analysis and financial modeling to explain how it is that private investors think about which transactions to engage in when they're partnering with conservation groups or public agencies, and how they make decisions about how to structure a transaction, whether to invest, how to put their money to work, and how to achieve both the conservation outcomes and the financial returns that investors and partners are looking for. So I'm going to start sort of at the highest level, talking about how some of these transactions are structured. I'll give an example of one to illustrate that. I'll then get a little narrower and talk about the different players in these transactions and what their incentives are. And then we'll get into the nitty-gritty of how some of these financial modeling decisions get made. And we'll talk about terms that like internal rate of return and or IRR and equity multiple, which may be very familiar to some of you, and complete gibberish to others. I will pause on a couple of occasions to the extent that there are questions that have accumulated, and so encourage you to put those questions in the chat or in the Q&A so that Helen can gather them, and then we'll spend some time at the end answering whatever questions have come up. So let's start, as I said, with a sort of high-level conceptual diagram of a transaction. And I should say also that the type of transaction I'm going to explain is a fairly typical one for the Lyme Timber Company, though there are lots of other types of transactions and ways to do them that are out there. And so this should not be, you shouldn't think of this as the only way that conservation transactions get done. This, I think, is a useful model that will help you to think about the different components of what it takes to bring a transaction together. So to start out, in order for there to be an investment that has conservation benefits to it, the first thing you need is some sort of piece of property that is of interest from both a financial and a conservation standpoint. And in order to have a piece of property, you've got to have someone who is willing to sell it. So the first component here is a seller, and that may be one of several different types of entities. It could be a TIMO, like the Lyme Timber Company. There are publicly traded companies that invest in real estate that may have land that is an attractive target that they're looking to sell. There's plenty of land out there that's owned by individuals and families that could be an attractive target for an investment and conservation transaction. And then, of course, property that is owned by corporations as well. So first component, need a piece of property, need someone who's willing to part with it, at least on some terms. And then the question is, well, how are you going to assemble the funding necessary to shake that property loose from the seller? And so the first component there is you need someone who's willing to make an equity investment, who's willing to essentially put their capital at risk and get both the benefits and the risks of engaging in that transaction. There are lots of types of investors out there. There are high net worth individuals and families, pension funds, foundations, endowments, funds of funds, and sometimes these groups will come together and invest in some sort of pooled investment fund that can then make the investment. And that's how TIMOs like the Lyme Timber Company work. We raise a series of investment funds that essentially accumulate capital from these different sources. So this is the first component of the buyer piece of the transaction. You need someone who's willing to make the equity investment. Now, often it is beneficial for a variety of reasons to use not only equity, but debt. And in the same way that when you buy a house, you typically put down a down payment and borrow money from a bank and give them a mortgage in exchange for a loan, often there is a debt component to the transactions that we and other investors will engage in. And there are lots of sources of debt financing. There are conventional banks who will lend against timberland, especially timberland that generates cash flow from timber harvesting. There are more esoteric programs out there. The Federal New Markets Tax Credit Program is a program that the US government has designed to encourage investment into low-income areas around the United States. Foundations may have PRIs, program-related investments, that they can structure as loans. There are in the various states, there is what's called a Clean Water State Revolving Loan Fund, money that is authorized by the EPA, but administered by the states, and that can be brought to bear for transactions that have certain clean water benefits. And there may be, as are sometimes in the case with our transactions, there may be conservation NGOs that are willing to lend money in order to see certain conservation outcomes achieved. So you've got a seller, a piece of property that's of interest. You've got equity investors who want to put money in. You've got debt providers who are willing to lend into the transaction. And hopefully those come together, and the buyer puts in the money, the seller puts in the land, and presto, you have the beginnings of a transaction. Well, in order to achieve the goals of the various players in this exercise, there needs to be some sort of thesis for how you're going to achieve both the financial and conservation goals of the transaction. And so for any successful investment, there need to be one or more sources of investment return. And so as a timberland investment organization, we're often pursuing sustainable timber harvesting as a way of generating cash flow. We have been very active in the sale of working forest conservation easements as a way of generating some investment returns that come back to investors. We'll talk about that a little bit later. There are various payment for environmental services strategies. You may have heard the term ecosystem services or PES, payment for environmental services, where if there's an opportunity to monetize certain conservation attributes of a property, that can generate investment return, and other sorts of sources of cash flow like recreational leasing for hunting, fishing, other sorts of outdoor recreation. So these are, you could think of these as essentially the management strategies that are utilized by whoever it is that's running this investment transaction. And for some period of time, these are the activities that are being undertaken in order to generate both the conservation outcome and the financial returns of the transaction. Now, equity investors and lenders often need to get their money back at some point. There are some sources of capital that have a perpetual horizon, but in many cases, there's a need to return capital to those investors or pay off a loan. And so typically in our transactions, we anticipate that at some point we're going to sell this property down the road to a buyer in the future. And the buyer may end up taking the property subject to whatever restrictions we've been able to put in place, conservation easements, forest carbon sequestration projects, other ecosystem services kinds of restrictions, mitigation, banking instruments, and the like. But in any event, there's someone who is willing to buy this property and this operation from us, and the proceeds of that sale will essentially allow us to pay off the debt, generate an investment return for equity investors, and everybody moves along. So this at a very high conceptual level is a way of looking at the different stakeholders and the different participants in a transaction. And to make it a little more concrete, I'll give you an illustration of a transaction that we executed a couple of years ago, or we're still in the middle of that transaction, you could say. But back in 2017 and 18, we purchased about 67,500 acres of timberland in north central Pennsylvania, just south of the New York border, a little bit of property on the New York side as well. And if you are in the timber business, you know that this area is the finest, the source of the finest black cherry hardwood in the world. And so you see a little picture here of some beautiful black cherry trees. And you can see from the diagram where the property is laid out and different colors for different dates and sources of the purchase. But we bought this property in two phases. a portion of it from the another TMO called the the Forest Land Group, and the second piece from Hancock Natural Resource Group, division of John Hancock Life Insurance Company. And one of the things that was interesting about this transaction is the financing. And so we used our investors' capital in the form of investment funds that we have raised to put in the equity. And we were able to secure some very attractive debt financing from two different sources. In the Commonwealth of Pennsylvania, there is an agency called the Pennsylvania Infrastructure Investment Authority, or PENVEST. And PENVEST typically provides loans to municipalities, utilities that are developing infrastructure for treating water to make sure that there's clean water available for the citizens of Pennsylvania. And so there is a state revolving loan fund that PENVEST administers that enables these sorts of investments in infrastructure to take place. We made a pitch to PENVEST that by protecting this 67,000 acres of timberland at the headwaters of some important riparian systems, that would actually have a meaningful and perhaps an even more powerful long-term benefit for clean water in the Commonwealth of Pennsylvania. And so we applied for a $15 million loan from PENVEST in order to facilitate our acquisition and our efforts to protect this property. And in exchange for that, we agreed to donate a working forest conservation easement over a portion of the property that would prevent that from ever being developed or subdivided, and also to do some remediation of some acid mine drainage areas as a result of past mining activity. And so this was an unusual loan for PENVEST to make. They're usually making much smaller loans for what you might call gray infrastructure, but had a lot of support from the administration, and we were able to get very attractive terms. This was a 20-year loan with 1% interest rate, and in fact, for the first 5 years, the loan required only the payment of interest. So very attractive financing that frankly made it possible for us to buy this property. We probably wouldn't have been able to afford to buy it without this financing. And then we also secured another $17 million of debt from one of our longtime conservation partners, the Conservation Fund, in exchange for an option that we provided where the Conservation Fund would have the right to acquire a working forest conservation easement from us over the balance of the property. And the plan is that they will assign that right to the Commonwealth of Pennsylvania just before closing, so that the Commonwealth will actually end up being the easement holder, assuming that money is available. So some innovative financing strategies to make this possible, and the management strategy, the sources of investment return were several-fold. We're doing sustainable timber harvesting subject to third-party certification under the Sustainable Forestry Initiative, or SFI standards. And there is a robust market for hardwood, especially cherry and oak in this area. We also made a 49.9% investment in a newly rebuilt high-tech sawmill that sits right in the middle of these lands, and gave us an outlet to sell the wood that we're harvesting off the property, and also some knowledge and exposure to the various markets, in particular export markets that are hungry for for hardwood from this region. And then, as I mentioned, we have been continue to work on trying to assemble the public financing that will make it possible for the sale of working forest conservation easements to the Pennsylvania Department of Conservation and Natural Resources, or DCNR. And that was a condition of the financing that we put in place, was that we would provide the state, through the Conservation Fund, the right to permanently conserve these properties through the purchase of a conservation easement. So those are sort of the high-level facts of how this came together, and then to layer that on to the framework that that we just talked about. So the sellers here who own the property were the Forest Land Group and Hancock Timber Resource Group. They had the property that was of interest. The equity investment came from actually two of our investment funds, the Lyme Forest Fund 4 and the Lyme Forest Fund 5. The transaction was a little too large for the remaining capital that we had in Fund 4, and it actually spanned the time that we were raising Fund 5. And so there were two sets of investment funds that were capitalized with investments from all of these types of investors, high net worth, pension, foundation, endowments, fund of funds. The debt, as I already mentioned, came from Penvest and from the Conservation Fund. That allowed us to consummate the purchase and then to manage it with an eye toward timber harvesting, this sawmill investment, which is generating cash flow as well. And then hopefully, if we can navigate the political challenges of public funding, which is always an issue, the sale of conservation easements to DCNR. And at some point in the coming years, we expect to find a buyer who is interested in purchasing the property from us, along with what we have built around it. So there's this investment in a sawmill that can travel with the investment. We've established a forest management firm that manages this property, hired local folks to manage it. And the idea is that those folks could also move on to a new owner along with the property itself. And if we're successful in selling working forest conservation easements to DCNR, then the new buyer will take the property subject to the restrictions in those conservation easements. So the property would be permanently protected by those easements, and we will have gotten the benefit of the proceeds of those easement sales, the buyer will have to abide by the restrictions of those conservation easements, which are likely to prohibit unsustainable timber harvesting, prohibit development, prohibit subdivision, essentially to maintain these properties as forests that are contiguous and can have the clean water benefits that inspired Penvest to lend us the acquisition financing in the first place. So,
David.
Yeah, I was about to pause. So, Helen.
Perfect timing, because it's relevant to this slide. And just a clarification from the chat box, if you can elaborate on equity investment and how it compares to debt.
Sure. So equity investors are those who are looking to, you think of it as the folks who are looking to have some timberland in their portfolio. For an individual, an investor might have some stocks and some bonds and maybe some commercial real estate. And they may also want to have some timberland. Timberland has certain investment attributes to it. It is arguably less risky than investing in the S&P 500, but probably more risky than buying a treasury bond. And so for investors who are looking to build a portfolio, timberland can fit in nicely, in the spectrum of risk and reward. The debt component is really like a loan, and the best analogy that I come up with is the one I mentioned before. When you buy a house, you may put down 20% of the purchase price in a down payment, and you may borrow 80% of the purchase price from a bank. And if the house appreciates, doubles in value, then when you sell it, you only have to pay the fixed amount off to the bank. You, as the owner, essentially you're the equity investor, you get all the upside from the appreciation of the house, and the bank only gets its loan paid off. But on the flip side, if the house loses money, then the bank gets its loan paid off first, and your equity in the house may get reduced or wiped out entirely. So it works the same way in a transaction. Lenders are interested in a safer return. They get paid back first. Equity investors are interested in being exposed to the asset and with all the upside and downside that comes along with that.
Thank you. One more question. Can you mention an example of a PES investment return source?
I didn't hear it. An example of what?
An example of a PES investment return source.
Sure. So the ones that you hear most about these days are carbon and wetland mitigation banking. So the idea of forest carbon sequestration is that you can enroll a piece of timberland in a protocol in which you agree to maintain a certain level of timber stocking and carbon sequestration over a long period, 40 years or 100 years. And in exchange for committing to sequester that much carbon, you as a forest owner can sell carbon offsets to greenhouse gas emitters who need them in order to offset their own greenhouse gas emissions as part of a plan to reduce emissions over the long term. So in that case, the ecosystem service that's being sold is a carbon offset, and the landowner can generate those by adhering to a strict, detailed set of rules for how you sequester carbon. Wetland mitigation banking is a concept where by restoring a degraded wetland habitat or a stream habitat to its original ecological function, a landowner can earn credits that can then be sold to developers who need to buy those credits in order to impact nearby resources in order to undertake development projects. So someone needs to to fill in some wetlands or remove some streams in order to build some sort of a highway or some infrastructure. One way they can offset the impact in order to obtain a permit to do that work is by buying credits from a mitigation banker who has done that restoration work proactively. So those are two common examples that you'll hear about.
Great. Do we have time for one last question before you keep moving on?
Sure.
Okay. Can you talk a little bit about what a future buyer looks like?
Sure. It varies based on the property and based on the transaction. In some cases, that buyer may be another TIMO who is willing to accept the restrictions that have been placed on the property as a result of our conservation activities, whether those be the conveyance of a conservation easement or the implementation of a carbon project. Perhaps there's a TIMO out there who's just looking to generate a stable cash flow from sustainable timber harvesting that is permitted under the terms of a conservation easement or a carbon project. And they may pay less for the property than we paid in order to buy the property in the first place, but that's because we were able to generate a return for our investors through either the sale of a conservation easement or the sale of carbon offsets. So in some cases, it's another financial investor who just has a slightly different way of weighing risk and reward in evaluating investment opportunities. There may be conservation groups in some cases that want to own a piece of property after we have executed our strategy, or there may be other types of financial investors. There's a large insurance company for whom we manage a 234,000 acre piece of property in the Adirondacks that's subject to a conservation easement, and they're interested in the timber cash flow. So different answers depending on the circumstances, but basically any buyer is going to look at what it is that we have created or what it is that we've modified through our ownership and decide whether it fits their investment criteria.
Great. Thanks for all the great questions in the chat, folks. So keep them coming.
So I'll move on to the second portion here and talk a little about some of the different players in these transactions and what motivates them and why you may want them in your transaction, why you may not want them in your transaction, and what drives their decision making. So private investors like the Lyme Timber Company are, play a role that can fill a gap to the extent that sources of public capital are more scarce than they used to be. And some of the mechanisms for transferring land to public ownership quickly are harder to come by. And at the same time, there are lots of properties out there that are in private hands that are not subject to any sort of protection through either easements or other mechanisms that assure conservation. And so private investors can sometimes step in to fill a gap and facilitate those transactions where public funding isn't as readily available. There are a number of regulatory and market forces that also create an opportunity for private investors. There are some real tax benefits to investing in timberland, and some investors are attracted to those. There was a question about PES markets a moment ago. Those have certainly become increasingly active and robust over the last few years. There is a mushrooming interest in what's referred to as impact investing, and the sense that investors want their capital to not only generate financial returns, but also have some sort of environmental benefit. So that's driving investors toward investment managers who do these sorts of transactions. And of course, there is just orders of magnitude more private capital available than there is public capital. And so there, just from a supply and demand standpoint, there's money out there. And what investors are looking for in putting their capital to work is they're looking for attractive investment opportunities for the property that can generate those financial returns in partnership with conservation interests to generate environmental outcomes as well. And so to the extent that investors have relationships with conservation groups and others who may be able to make them aware of deals they wouldn't otherwise have come across, that's certainly attractive to investors. And investors like the Lyme Timber Company are eager to partner with conservation groups, both to leverage their expertise and also to have the credibility that comes from being in collaboration with somebody that really speaks for ecological and environmental benefit. So having said that, in order to partner with private investors and utilize private investment capital, it's important to understand what are the values and what are the objectives that private investors have in pursuing transactions like this. And so there are a number of different drivers of why it is that that investors are interested in this esoteric corner of the investment world. But many of these investments, timberland in particular, are generally thought of as being pretty stable investments, real assets, real estate that either maintains its value or appreciates in value is important as markets are turbulent. There is some hedging against inflation and the ability to both generate current income and cash flow as well as appreciation over time. For investors who are interested in having a diversified portfolio, having some of your capital tied up in assets that are not particularly correlated to what the stock market is doing is an important driver. And then there are other, more fundamental drivers of value, population growth, loss of farmland and timberland, land and water as not having. There's a finite supply, obviously, no one's making more of those. And then some of the technology that we're seeing brought to bear in timberland, in agriculture, and ecosystem services markets are also making some of these investments increasingly attractive. There are tax benefits, as I mentioned, a variety of different sources of value from these investments, from more traditional revenue streams like timber harvesting and leasing to some of these PES strategies, carbon mitigation banking, renewable energy. And then the ability to bring innovative and creative sources of financing can also serve as a way to drive value for investors. Now, that all sounds great, but the bad news, if you will, is that private investors tend to be extraordinarily selective. We have, as a firm, looked at probably 10 or 20 or even more deals and passed on them for every one that we have decided to move forward on. And there's a lot of due diligence that has to happen, and a lot of stars have to align in order for an investment opportunity to meet the criteria that we have for both financial returns and conservation benefits. And so it is not, while there is a lot of private capital out there, it doesn't mean that it is just free for the taking whenever a deal comes along. I've referred on a number of occasions to the role of conservation NGOs, who are our valued and loyal partners in many of these transactions. And there is somewhat of a symbiotic relationship between conservation NGOs and private investors when everything works out as it should. Conservation groups who are looking to achieve conservation outcomes on the lands that they target value private investors because they can respond quickly. They are not bound by very rigid rules about how a transaction needs to be structured. So there's a certain amount of creativity and innovation that can take place in putting together a deal. Typically, when we make an investment, we keep that land as a working forest or working ranch land, which is beneficial from an economic standpoint, from a local community development standpoint. And having private capital brought in to make investments is appealing, to people on both sides of the aisle, because it doesn't depend on having public dollars allocated to some of these transactions. Private investors can be an innovative source of matching funds when there are public programs that will fund some but not all of a transaction, and can provide some efficiency and credibility, as well as the certainty of being able to get a transaction done when you're working with a professional investor group. They're in the deal business. They know that there's a certain process, and you need to get from A to Z in order to get the transaction done, and there's a certain amount of experience that comes with having formed the capital and raised the money to be able to put that capital to work. So those are some of the reasons that conservation groups like to partner with private investors, and private investors really depend on the expertise and the relationships and the connections that conservation NGOs bring in monetizing and figuring out how to realize some of the conservation potential of these properties. I want to go one level deeper here and talk a little about a term that I've referred to several times, the working forest conservation easement. And many conservation NGOs are familiar with the concept of a conservation easement generally, and often it's in the context of a donation. So a landowner wants to conserve the property, wants to donate a conservation easement. They find a land trust who's willing to accept a conservation easement. There needs to be an appraisal if the investor wants to take a tax deduction. To jump through a lot of hoops with the IRS. Often the conservation NGO will need an endowment in order to manage it. These are sort of classical conservation easement transactions. That is not what I'm talking about here. What I'm going to talk about a little bit are working forest conservation easements, which are typically on a much larger scale. And when we do one of these transactions, we are buying a property and then looking not to donate a conservation easement, but to actually sell a conservation easement to a public agency, often with the assistance of a conservation NGO. So you can think of these transactions as being in 4 phases. The first phase, and the Pennsylvania example that I mentioned is a perfectly good one here. The first phase is that we would buy the property in fee simple, essentially all the rights unencumbered to do whatever we'd like with. And we would work closely with our conservation NGO partners to identify lands that have attractive conservation attributes. And typically we look to enter into an option agreement with a conservation NGO partner in which the conservation NGO essentially acquires the right to buy from us a working forest conservation easement sometime in the first several years of our investment. And that's an important right that the conservation NGO has, because it then gives the conservation NGO the ability to go to state agencies or other sources of public funding and say, hey, we've got this valuable right. We can essentially force the Lyme Timber Company to sell us a conservation easement if you can help us come up with the money during our option period. And so that may be a 3 or 4 or 5 year period, and we would sell that conservation easement for cash. Typically, a conservation easement of properties that we are buying will appraise for between 30 and 50% of the value of the property. And so as you see in this diagram, we are in a sense diminishing the value of the property. That's the green part here, because we are extinguishing or selling off these rights under the conservation easement. But then we will spend some time trying to enhance the property's cash flow generating ability. We'll look for ways to do sustainable timber harvesting in a way that is more efficient and generate a cash yield that is now relatively larger compared to what the property is worth, because we've diminished its value through the sale of conservation easement. And then that final step, the sale to a future buyer, we're looking to sell perhaps the land and the operating business that we establish along with it. And so the returns to our investors come from a combination of the sale of the conservation easement, the generation of cash flow each year from timber harvesting or ecosystem services, carbon offsets, whatever, and then ultimately the sale of the encumbered property at the end of our investment period generates the balance of the return to our investors. I think that's another good place to pause. Helen, I'm relying on you to monitor the chat window.
Yeah, that's great. I've got 2 questions. So this is, again, we're really hitting this perfect timing, David. So from the chat box, you mentioned that timber investments could be less risky than the S&P 500, but does climate change pose a significant threat to returns? I'll stop there because it's a 2-parter.
Okay. Well, I think the answer is you need to take into account climate change in any investment. We need to take that account in any investment that we make. And so depending on where you're investing, climate change may present a very significant risk or very low risk at all. About a year and a half ago, we bought in 3 transactions about 675,000 acres of timberland in the Upper Peninsula of Michigan, which is one of the most climate resilient areas in the country, if not the continent. And so that's an area where climate change doesn't pose a whole lot of risk. There are others where climate change might actually create some benefit to the extent that it increases growth rates. I mean, that's not something that anyone hopes for, but trees generally grow a little faster when it's a little bit warmer. Now, if you're going to buy timberland that's right on the coast of a state that's likely to be flooded, then obviously you have to factor that as a risk. But I think the answer to the question is climate change is critical to take into account, but how it applies to any given investment is a fact-specific determination.
Move on to another question I have. Is Lyme timber able to offer the same market returns as other TMOs that don't have the same conservation ethic?
Well, I have to be careful because among other hats I wear, I serve as the General Counsel and Chief Compliance Officer of the Lyme Timber Company. And so we tend to be circumspect about returns. But I will say that historically, our returns have exceeded the industry benchmark significantly over a 20-25-year period. And we believe that that's because we have a quite different strategy than many TMOs that are managing timberland in a conventional and less active, operationally focused way. So some of the strategies that I'm talking about here in terms of conservation easements, forest carbon mitigation banking, for years, we were the only TMO that engaged in those activities. And we tend to be selective in choosing those investments that are able to meet the market return expectations of our investors. And as a result, it just means that we make fewer investments than others because we're looking for investments that can generate above market returns as well as conservation benefits. And the Venn diagram of investments that meet both of those sets of criteria yields a fairly small overlap area. So yes, we do target and have generally achieved returns that are in excess of what other TMOs bring, but it's because we have a very different strategy.
Thanks for that clarification. Let's see. Here's a question about 30 by 30. Do you see any policy changes at the federal level that would make it more attractive for private capital investments in land conservation?
Well, to the extent that 30 by 30 is going to result in additional sources of public funding, the portions of our investment strategy that depend on public funding, such as the sale of conservation easements, certainly stand to benefit from increased funding. And having said that, historically, most of the funding, the public funding that we've had for our conservation strategies has come from state sources and not from federal sources. LWCF has certainly been helpful, and we've done a bunch of forest legacy deals that even those are administered through the states. And so I think the answer is cautiously yes. That we would like to think that anything that encourages more conservation and provides funding for conservation will privilege investments of the sorts that we're looking for. But there are other strategies that we pursue, such as some of these PES or ecosystem services strategies that really don't depend on public funding. And so we're certainly not relying on that for the future of our investing over the next 10 years or so.
Great, thanks.
I want to jump, I just want to make sure that we leave enough time for what for me is the most fun part of this. And for some of you it may be, and some of you may want to jump off a bridge. But the next layer of drilling down here is to talk about how investors make investment decisions and some of the key considerations and terms that we use in evaluating investment opportunities. And so the Finance 101 section here of the presentation starts with this concept of the time value of money. And the basic principle here is that $1 today is worth more than $1 in the future. Why is that? Well, you could invest your $1 today in some, in a bank account or in some other investment. It'll be worth more tomorrow. And so it is particularly important in making investment decisions to evaluate in today's dollars payments over a period of time. And so the concept of present value, or PV, refers to the current value in 2021 dollars of future payments that are discounted back from the future at a particular rate in order to reflect the risk and this time value of money. And so I want to talk about this as a basic concept, and then we'll apply it to some examples of investment decisions, especially around timberland and other strategies. So assume, just for the sake of discussion, that you have the opportunity to make a $100 investment, and you know that if you make that investment, you're going to get $10 back in year 1, $10 in year 2, $10 in year 3 and 4 and 5. And then at the end of 5 years, you're going to be able to sell that investment and get $120. So that's your cash flow outlook. And if you look at this first line that says undiscounted, you make a $100 investment, $100 out the door, you get $10 back, 10, 10, 10. And then in year 5, you get your $10 plus your $120 from the sale of the investment. And if you add all of those up without any discounting, those total $170. So that is the present value of these cash flows if they aren't discounted. But then, of course, you have to subtract the $100 that you paid in order to have any meaningful sense of what you made on the investment. So the NPV, or the net present value, is 170 minus the 100 you put in, $70. So if you weren't paying any attention to the time value of money or to this question of risk, that's how your investment would look. Well, let's say that you wanted to take into account the time value of money and you wanted to discount back future payments at a rate of 5% a year. So you make your investment $100. Your $10 at the end of 12 months isn't worth $10 really. It's worth $10 discounted by 5%. And so 10 divided by 1.05 is 952. And then in year 2, that $10 is worth less because it's now 2 years out, not 1. It's worth 907. And then year 3, year 4. So you can see how when you discount each of these dollar amounts back to the present value, back to 2021, they're worth a little less. And if you add all those numbers up at a 5% discount rate, $137.32 is your present value. Subtract out the $100 that you paid for this investment, and your net present value is $37.32. So $37.32 is what you made on this investment. Not too bad on $100. But as you can see, as you increase the discount rate that you apply to these future cash flows, the effect is a little more pronounced. Now your $10 in year 1 is worth only $909 and $826, and you add all these up, and now your present value is $112.42. Subtract out your initial investment, it's $12.42. The higher the discount rate you apply, the lower the return is, the lower the net present value is from your investment. And in fact, if you apply a discount rate that's as high as 15%, you see that these numbers drop enough that adding up year 1, 2, 3, 4, and 5, you only get $93.18 as a present value. That's in 2021 dollars. You paid $100 for it, so you actually paid $100 for something that's worth only $93. You've lost almost $7. It's a negative NPV. And so depending on the discount rate, that will drive what the investment return looks like on the investment. So a question that people always ask when they see this chart is they say, okay, well, but how do you determine what's the appropriate discount rate here? These are arbitrary numbers, 5, 10, 15, and how do you know what to apply? And there are several different ways to think about that. The classical corporate finance theory is that there is some risk-free rate, and then you add on to that a premium to pay the investor for the risk that the cash flows don't actually materialize in the way you expected. So I gave this very simplified example that says you're sure that you're going to get $10 in year 1 and $10 in year 2, but life isn't a sure thing, and so people generally want to take into account the risk that things don't actually happen as expected. So that's one way to think about the discount rate. Another way to think about the discount rate is that an investor may have a particular required rate of return that they need to earn, and so they apply that rate of return as the discount rate. And if a particular investment doesn't meet that investor's rate of return, then they're not going to make the investment. And then another way that people sometimes think about it is that investors may have a particular cost of capital. Their equity investors may have a certain expectation, their lenders may have a certain interest rate, and you can blend those together and come up with a blended cost of capital and use that as your discount rate. But that's a very fundamental concept here, which is that there is a time value of money and that discount rates can be used to capture both the time value of money and the risk that things don't materialize as you expect. So how do investors evaluate the performance of a prospective investment in trying to decide whether to move forward? Well, they usually start with a forecast of what the cash flows are going to be from a particular investment. And then they figure out, well, what's the discount rate that would make this a neutral proposition? And that concept is called the internal rate of return, or the IRR. So what is IRR? Well, you can think of it as it's the annualized compounded rate of return of an investment. Going back to our previous slide, you can think of it as the discount rate at which the future cash flows will yield a net present value of 0. So looking back at this slide, you saw that as the discount rate increased, 5, 10, 15%, the net present value decreased. And you can figure that somewhere between these last two lines, somewhere between 10 and 15%, probably around 13%, would be the discount rate at which the net present value would be 0. And so if we had inserted a line here with a 13% discount rate, it would have a net present value of 0. Another way of saying that would be that this investment would have a 13% IRR. So IRR, or the discount rate at which forecast cash flows will yield a 0 net present value. It's especially useful for evaluating cash flows that are irregular, because you can apply the same discount rate to cash flows no matter when they occur, and they can be lumpy. Another thing that investors pay attention to is multiple, sometimes referred to as equity multiple or cash on cash return. And the concept here is to say, all right, put aside the discount rate and the time value of money. How much am I putting in? How much am I getting out? That's the concept of multiple. And so just a couple of examples of this concept. Let's say, again, very simplified, there was something you knew that you could buy today and you could sell it in 5 years for $200. Well, if you put that into Excel or your scientific calculator, you'll see that it has an IRR of 15%. But the multiple, which you can do in your head, is 2.0, because $100 in, $200 out, you're getting 200 back, divided by 100, 200 divided by 100 is 2. Now, if you had another opportunity, you could buy today at $80 and sell in 5 years at 200. Well, that, intuitively, that's going to be a better investment because you're getting the same 200 in 5 years, but you only have to pay $80 for it. And the multiple there, in fact, is 2.5x. 200 divided by 80 is 2.5. You're getting 2.5 times your money. And if you plug those numbers into a scientific calculator or Excel, you'll find that the IRR is 20%. And so again, it's sort of intuitive that the better investment is going to have the higher IRR and the higher multiple. But let's talk about the a somewhat less simple example where there might be regular cash flows along the way. And let's assume that you can make a $100 investment, but you know that you're going to get $10 a year each year, and then at the end of 5 years, you sell it for $100. Well, $10 for 5 years is 50, add the 50 to 100, you get $150 back, you put $100 in, multiple of 1.5x. And if you put those cash flows, 10, 10, 10, 10, 110, into Excel, you'll see it has an IRR of 10%. But let's also assume an alternative investment. You put in $100, you get $20 a year for the first 5 years, but then the value of the asset has been eroded. So at the end of 5 years, you can only sell it for $50, not 100. Now let's see, 20 plus 20 plus 20 plus 20 plus 20, that's $100 in those annual cash flows plus 50 at the end. Hey, it's the same $150 you get back. So it's the same 1.5 times multiple, but the IRR here is 12% instead of 10%. Why is that? Well, the reason is that in the second investment, you're getting more of your return earlier. You're getting $20 a year instead of $10 a year. And so the time value of money suggests that those earlier cash flows are worth more. And it also de-risks the investment because the more of your money you can get sooner, the better off you are from a return standpoint. So this is an important illustration of something that we'll now look at with a slightly more realistic example, because accelerating cash flows and bringing return earlier in the investment cycle is beneficial from an investment return standpoint.
David, can I just stop you for a second, making sure people are rightly concerned for your safety and welfare. So we're just...
It is not in my building. I did hear that and think this would be an interesting twist to this presentation if I had to evacuate, but okay. I'm watching the alarm out across the street from me. So thank you for the concern, but I am fine.
Good to know. Good to know. All right.
And unfortunately, I can't mute that. So we're all in the same boat. Okay, let's make this example a little more realistic. So we can buy a piece of timberland for $100,000. We know that we can generate $10,000 a year in annual cash flow. And there are two ways that we could sell this, two scenarios under which we could sell this property. We know it's going to appreciate. In 5 years, our crystal ball tells us we could sell the property for $120,000. Or we can take the more classic Lyme timber approach and say, all right, we're going to sell a working forest conservation easement on this property for $40,000 in year 3. And then in year 5, we're going to sell the property for $90,000 because encumbered property is worth less than unencumbered property. So we can't expect to get as much for it as we would get on an unencumbered basis. But we'd be selling it subject to the restrictions of the conservation easement, and we think an investor would be willing to pay $90,000 for it because they've given up some of the optionality. They've given up the opportunity to develop it or subdivide it. So how would an investor model the range of potential outcomes given these two investment decisions? So a couple of examples. Looks like they've put out their fire. So in the first case, these numbers may look a little familiar. $100,000 out, $10,000 a year in timber harvesting cash flow, and then we sell it for $120,000. Excel tells us that generates a 13% IRR. And if you add up these numbers, 10, 20, 30, 40, 170, 170 out for 100 in, that's a 1.7x multiple. Okay. Well, the second example that I gave is the easement example. So we pay $100,000 for the property, 10,000 from timber, 10,000 from timber in years 1 and 2. In year 3, we get the 10,000 from timber, but we also get $40,000 from the sale of the easement. So that's 50,000. Then in year 4, we get another $10,000. And in year 5, we get $10,000 from timber harvesting plus the $90,000 for the sale of the encumbered fee. Okay, add all this up, 10, 20, 70, 80, $180,000. 180 divided by 100 is 1.8 times equity multiple. And Excel tells us that we have a 16% IRR. So slightly better multiple, meaningfully better IRR from selling the easement earlier in the investment cycle. And again, this is as a result of de-risking the investment by returning capital earlier. So that's the 130 that generates the 1.7 multiple. Then you see the sale of the easement in year 3, that's 40 plus 10. Okay, now what happens if our conservation partners are really talented and hardworking and they're able to get the easement sold a year earlier? So the exact same numbers, but we accelerate this $40,000 payment from year 3 to year 2. Well, same multiple because it's the exact same amount of cash, but look at this, the IRR is 18% instead of 16%, because again, we've pulled forward this cash flow, we've generated the same amount of money, but we've generated it earlier. And so the time value of money means that there's less discounting that takes place. And this ends up being a better outcome. Now, another example, we're able to sell that easement in year 2, but we're also able to sell the property not for $90,000, but for $100,000 plus our $10,000 in timber harvesting. IRR is now up to 19%, and because we've generated some extra cash, we're now at a 1.9 times multiple. And then finally, and this may explain why, if you've worked with a private investor, they're so focused on trying to reduce the purchase price up front. If you can buy the property not for $100,000, but for $80,000, but still generate the same 10, 10, 50, 10, and 100, suddenly you've got a 2.3 times multiple and a 24% IRR. And so you see the sort of the benefits from pulling cash flows forward, increasing investment returns at different stages of the investment, reducing the purchase price up front. These are the things that investors spend hours and hours modeling and trying to figure out and doing sensitivity analysis to figure out how do changes in those assumptions affect the investment outcome. So imagine doing this on a larger scale with many more different variables and lots of spreadsheets, but this is the methodology that allows investors to determine what investment do I want to make if I'm choosing between multiple investments, which one is better, and what areas do I have to do more due diligence on in order to determine whether or not this investment makes sense. It looks like we only have 5 minutes left, so I will pause there and turn it over to Helen for questions.
That's great. We made it. So that was great. We just have a few questions to round out the session. Thanks again, David. You touched so much on the alignment and symbiotic relationship that Lyme Timber has working with conservation NGOs. So I'm curious, when a conservation NGO reaches out to Lyme Timber or to another private investor, what's some of the due diligence that they should have already completed, or what are some of the questions that they should have asked themselves before making that initial call?
Well, we're happy to talk to anyone anytime. But some of the first questions that we will ask have to do with some basic information about the property and whether it is in fact available for sale. You can waste a lot of time talking with sellers who aren't really interested in transacting. But really what we're going to focus on is the investment thesis or the management strategy. What are the ways that we can generate returns in a way that's consistent with the objectives that we and our conservation partner are trying to achieve? Is, what's the timber harvesting potential? What are the markets like? What are what species are on the property? How heavily has it been harvested? What's the road systems? All the questions that foresters want to know in order to evaluate a timber resource. What sources of conservation monetization might there be? Is there an opportunity to sell a conservation easement? How high a priority is this property in the conservation community in the state where it's located, both among NGOs and among public agencies that have funding to commit? How many other properties might be ahead of it in the queue? Is there a potential for payment for environmental services models? Are there portions that can be restored? Is there a carbon project? What are some of the impediments to pursuing other sources of cash flow? Are there renewable energy or recreational lease opportunities? So everything that we're trying to do is to build that model, that very detailed spreadsheet that's going to allow us to forecast the cash flows and figure out whether we can buy the property at a price that will enable us to generate the return that our investors are looking for, while being true to whatever the conservation objectives are of the conservation group that's called us up in the first place.
Great. I think that's all we have time for, folks. We have 5:13, 5:14 Eastern. We have a happy hour that starts in about 15 minutes on this same Zoom link at 5:30 if you can join us. And if not, tomorrow we'll be back for session 3, Innovation Roundup. Thank you so much, David. Over a decade of presenting principles of finance, and it was great. Thanks again.
Thanks very much. Pleasure to be here.
All right, see you all later.